I've spent years studying successful entrepreneurs, investors, and creators, and through trial, mistakes, and small wins, I've learned that wealth isn't about chasing money. It's about becoming the kind of person who attracts it. In this video, I'll share 50 practical principles for making money, real lessons that combine mindset, habits, entrepreneurship, and investing. 1. You don't have to be smart to get rich. Many people believe you need a genius IQ or fancy degree to build wealth, but that's a myth. Getting rich is more about strategy, consistency, and common sense than raw intelligence. Everyday people get rich by playing the game of money consistently and outworking others, not by outthinking them. In fact, overanalyzing and thinking too much can sometimes paralyze action and make you miss clear opportunities. The real keys are simple: hard work, persistence, and a willingness to keep learning. If you keep moving forward and stay disciplined, you don't need to be the smartest person in the room to achieve financial success. 2. Saving gives security to take risks. Having savings doesn't automatically make you a billionaire, but it does give you freedom. A strong savings account acts like a safety net, so you can take calculated risks without fear of disaster. When you have a cash cushion, sometimes called an emergency fund or oh no fund, you won't be forced into bad decisions just because you're desperate. In practice, this means saving enough to cover a few months of living expenses. With that security, you can leave a dead-end job, invest in your business, or jump on a one-time opportunity, knowing that you have backup funds. In short, building good saving habits provides the stability needed to act boldly when it matters most. 3. You make all the money at once. The biggest breakthroughs often come from a single idea, sale, or product. It's in that big moment that you make most of your money. Your first major success, like landing a big client or launching a hit product, often sets the stage for rapid wealth, and the rest is about multiplying that success over time. For example, a startup founder might land one game-changing deal, then replicate and scale. This principle means you should focus intensely on capturing that first win. Put enormous effort into getting your first big sale, job offer, or customer. It will change your financial trajectory far more than dozens of small wins. Once you've achieved that breakthrough, you can reinvest and grow from there. 4. Money always chases the best. Wealth tends to flow toward excellence. If you become the best at what you do, whether that's a service, product, or skill, money will follow. The market rewards top performers and innovators, so focus on solving problems better and faster than anyone else. For example, the most successful businesses and careers are built on offering outstanding value that others don't. When you deliver exceptional quality or unique value, customers and clients will seek you out and pay premium prices. In short, aim to be outstanding in your niche or profession. By striving for excellence, you naturally attract more money than staying average. 5. Make money actively, before passively. Passive income is a great goal, but in the early stages you often need to hustle for active income first. Active income means trading your time or immediate effort for money, like a job or a business venture. Passive income, rent, dividends, royalties, usually comes later, once you have capital or systems in place. The rule is, build your active cash flow first so you have something to invest. For instance, start by growing a business, consulting, or working a high-paying job and save that money. Then turn around and use those savings to create passive streams, like investing in stocks or property. Trying to set up passive income too soon can leave you empty-handed. Focus first on earning actively, then channel those earnings into passive vehicles. 6. If money is the only goal, you'll never have enough. When you chase money purely for money's sake, satisfaction always seems just out of reach. If wealth is your only purpose, you'll keep raising the bar endlessly and never feel content. Instead, focus on value and purpose. When you solve real problems, help others, or build something meaningful, money naturally follows as a byproduct. In practice, this means loving the process of creating or contributing, not just the dollars. For example, many entrepreneurs say they became successful only after they stopped obsessing over money and started caring about impact. By making money a consequence of your work rather than the sole goal, you cultivate fulfillment and ultimately attract wealth. 7. Don't have shame if you have no money. Being broke or starting from nothing is not something to be ashamed of. It's a starting point. Many of today's successful people started with little or no money. What matters is what you do next. Shaming yourself or hiding your financial status only wastes energy and keeps you stuck. Instead, openly acknowledge where you are and use it as fuel to learn and improve. For example, budget carefully, seek financial education, or ask for help from mentors without embarrassment. Remember, poverty isn't a character flaw, and many wealthy mentors will respect someone who is willing to learn and hustle. By letting go of shame, you free up mind space to focus on growth and strategy. 8. Stop counting other people's money. It's easy to look around and compare your bank account or success to friends, colleagues, or social media personalities. But doing so only distracts you from your own path. Everyone's financial journey is different. You don't know the full story behind someone else's income or wealth. Wasting time calculating others' earnings breeds envy and anxiety, and it steals focus from your own progress. Instead, keep your eyes on your own goals and numbers. If you do feel tempted to compare, quickly redirect that energy into improving your own skills or projects. By concentrating on your own efforts and growth, you'll make more progress than by obsessing over others' bank balances. 9. Change your behaviors. Good intentions and knowledge alone won't make you rich. You have to change your habits. If you want different financial results, you must do things differently. This means examining your daily routines and making practical adjustments, perhaps cutting unnecessary expenses, dedicating time each day to learning about money, or proactively seeking new income opportunities. For example, if you spend evenings watching TV, you might instead spend 1 hour developing a side skill or working on a small business project. It's these small, consistent behavior changes, not gimmicks, that add up. Identify one bad financial habit and replace it with a positive one this week. Over time, these new habits compound to transform your financial life. 10. Solve difficult problems. Big money often comes from tackling the big challenges that others avoid. Difficult problems are usually high impact and high value. If you find a genuine issue that few people are addressing, whether in your industry or everyday life, and solve it, there is a strong chance to profit. For instance, inventing a new technology, developing a life-changing app, or fixing an inefficiency in a market can bring outsized rewards. The principle here is to seek out challenges beyond your comfort zone. You might not see easy shortcuts when starting, but solving hard problems is what makes products and services indispensable. Embrace complexity and do the work others shy away from. In doing so, you not only create value for others, but often secure a big piece of the rewards yourself. 11. Focus on increasing your savings. Think of money management like a game where the high score is your savings rate. Measuring your progress by how much you save, not just how much you earn, is powerful. Wealth building is less about maximum income and more about how much of that income you keep and put to work. A healthy savings habit means you live below your means, spend less than you earn, and consistently invest the rest. By boosting your savings rate even a little each month, you steadily compound wealth. To make this tangible, track your monthly savings and set incremental goals. When viewed as a competitive challenge against yourself, improving your savings becomes motivating. Remember, it's easier to save a little more each month than to suddenly make $1,000 more. Focus on improvements you can control. 12. Avoid FOMO. Make deliberate investments. The fear of missing out, FOMO, can wreck your finances if you're impulsive. Markets, businesses, and trends rise and fall. Just because everyone is rushing into a hot stock or the newest get-rich-quick scheme doesn't mean you should. Instead, develop a calm, deliberate approach. Do your research and take your time to understand an opportunity before committing funds. In practice, that means waiting for a good entry point rather than buying at the peak hype, or simply not investing at all until you have savings. Many of the wealthiest investors actually bought after prices dropped, not at their highest. Remember, good deals don't vanish in 24 hours. Patience often protects you from costly mistakes. By avoiding emotional buying and sticking to a plan, you keep your capital safe and grow it smartly. 13. Build an emergency fund. Life is unpredictable. Job losses, medical emergencies, or sudden costs can derail anyone without warning. Having an emergency fund of cash set aside, often 3 to 6 months of expenses, gives you a powerful advantage. With this fund, you won't be forced to panic sell investments or incur high-interest debt when something unexpected happens. You can use opportunities even during downturns because you're not scrambling. For example, with emergency savings, you might be able to keep your business running through a slow period or invest in a bargain while others are pulling out. In short, an emergency fund is not money you need to spend now, but the buffer that lets you take risks and make clear-headed decisions. Building this fund gradually is a key first step on the path to wealth. 14. Diversify your efforts and investments. Putting all your eggs in one basket is risky. Whether it's a single job, one business idea, or only one type of investment, dependence on a single source leaves you vulnerable to failure. Diversification means spreading risk. For income, this could mean having multiple side gigs, different skills, or varied clients. For investments, it means holding a range of asset types, stocks, bonds, real estate, etc., and industries. This way, if one stream dries up or one sector tanks, the others can carry you. Diversification won't make you rich on its own, but it helps prevent ruin. By not relying entirely on any one source, you protect the progress you've made and ensure steady growth over time, even when unexpected challenges arise. 15. Invest for compound growth, long term. True wealth is often accumulated quietly, over years or decades, through the power of compounding. This means reinvesting your earnings so that you earn returns on top of returns. For example, dividends or interest you don't spend get added to your principal, earning even more in the next cycle. To harness compounding, take a long-term view, buy quality assets and hold them. Avoid frequent trading or trying to time the market. Some of the greatest fortunes have been built by investors who buy and hold. They let growth build on itself over time. In practical terms, start investing early and consistently. Even small amounts grow into significant sums given enough years. Patience is key. Compounding rewards those who stick with it. 16. Automate your finances and savings. You can't count on willpower alone to manage money. Systems do the heavy lifting. Automating your finances removes the need to make a decision every month. Set up automatic transfers so that as soon as you get paid, a fixed portion goes to savings or investments before you even see it. Automate bill payments to avoid late fees. Use tools or apps to round up purchases to invest spare change. When your money moves on autopilot, you eliminate the temptation to spend first and save what's left, which rarely happens. This pay yourself first strategy makes saving and investing consistent and effortless. Over time, these automated increments add up to a large nest egg with minimal daily effort. 17. Use debt strategically. Avoid bad debt. Debt isn't inherently bad, but you must know which debt to use and which to avoid. Good debt is borrowed money that can help you generate more income or grow your net worth, like a mortgage on rental property or a business loan used to expand operations. Bad debt is borrowing that covers immediate consumption without generating future value, like credit cards for shopping sprees. The principle is to use debt as a tool, not a trap. When you take on debt, be sure the expected return exceeds the cost interest, and pay off high-interest debt as fast as possible. It's a leak in your finances. By managing debt wisely, leveraging it when it can propel you forward, and avoiding it when it holds you back, you maintain financial flexibility and power. 18. Save a portion of every income source. Every time you receive money, whether from salary, a side gig, a gift, or dividends, put a portion of it towards savings or investment before you do anything else with it. This pay-yourself-first mentality treats saving as the top priority. For instance, if you get a 5% raise, automatically save 5% more instead of ramping up spending. If you earn from a side project, immediately invest a share. Doing this consistently ensures that your wealth building never stalls, regardless of income swings. It also builds discipline. You soon think of yourself as budgeting from your new total. Over time, saving even small percentages from each source adds up, making you less tempted to inflate your lifestyle with every extra dollar. 19. Create value exponentially. Charge accordingly. Your income will ultimately reflect the value you provide to others. Strive to solve problems or fulfill needs on a large scale, and you can command a share of that value. For example, if you're a consultant or business owner, focus on delivering solutions that save clients time, money, or headaches, many times over what they pay you. When you provide 10 times the value you charge for, clients happily pay premium rates. Price yourself, or your product, based on the outcome you deliver, not the hours you work. In practice, this means thinking bigger. Instead of saying, "I'll charge $50 per hour," say, "I'll help you increase your revenue by $10,000. That mindset shift allows you to negotiate from the perspective of results. By always aiming to generate outsized benefit for those who pay you, your own rewards grow exponentially. 20. Delegate and build systems. You can't do it all. One person can only accomplish so much. To multiply your efforts, delegate routine tasks and build efficient systems. This might mean hiring assistants, outsourcing bookkeeping, or using software tools. For example, a small business owner could hire virtual help for customer support, freeing up time to strategize new growth opportunities. When you create step-by-step processes for repetitive work, like standard operating procedures, you or others can execute them repeatedly without reinventing the wheel each time. By doing so, your business or project can run even when you're not personally handling every detail. The result is that your time gets freed to focus on the highest impact activities, leading to faster scaling and more wealth creation without burning you out. 21. Treat your time as valuable. Don't trade it cheaply. Time is one of your most limited resources. Be mindful not to sell it for less than it's worth. This principle means you should avoid jobs or deals that pay far below your skill level or market rate, unless it's for strategic experience. Instead of trading hours for low pay, focus on opportunities that maximize your hourly income. For example, if you can automate a task or learn a skill that increases your output, invest in that instead of working more menial hours. Also, look for ways to replace time with efficient solutions, like software or outsourcing. By always considering the true value of your time, you make decisions that protect your ability to earn more money per hour and use your limited time in the most effective way. 22. Create or find recession-resistant income streams. Economies go through cycles, Certain businesses and income sources fare better during downturns. For example, essential services, like healthcare, utilities, or basic consumer goods, tend to remain in demand even in recessions. If you work for or invest in industries that survive hard times, you'll have an edge. Similarly, building a subscription or recurring revenue model, like membership services, provides consistent income that isn't tied to one-time sales. To apply this, evaluate your own income streams. Can you pivot or add offerings that people need no matter what? By having a portfolio of income that withstands bad times, you protect your finances and may even find opportunities when others pull back. 23. Reinvest a large portion of profits into growth. Once you start making money, resist the urge to inflate your lifestyle immediately. Instead, funnel a significant portion of profits right back into your business or investments. This accelerates growth. For example, a growing business owner might use extra revenue to launch a new product line, market more aggressively, or improve customer experience. An investor might plow dividends back into more investments. This reinvestment multiplies your money faster than spending it. Over time, continually reinvesting turns smaller gains into much larger ones. The habit to adopt is, every time your wealth grows, redirect most of it toward the next growth opportunity, rather than spending it on non-essentials. 24. Focus on one business until it succeeds, then scale. Ambition can tempt you to juggle multiple projects at once, but spreading yourself too thin often means none will reach its potential. It's usually wiser to concentrate on one business or venture until it's stable and thriving. Dedicate your best resources, time, energy, capital, to make that first enterprise successful. Only after it's solid should you consider expanding or starting a new one. This approach might mean forgoing some quick side projects, but it ensures you fully capitalize on your current opportunity. Once that initial success is achieved, you can more easily replicate the model, hire others, or invest profits into additional streams. Mastering one venture before launching another minimizes risk and maximizes learning. 25. Negotiate and ask for what you're worth. Many people undercharge or undersell themselves out of fear of losing the deal. This mindset leaves money on the table. Instead, cultivate confidence in discussing money openly. Whether you're getting a raise at work, setting freelance rates, or selling a product, ask for fair compensation. Prepare by understanding industry standards and practice articulating the value you bring. Remember, the worst that can happen is a no, and you still gain the confidence to try. Over time, effective negotiation becomes a habit that boosts your income. Even a small increase in price or salary can compound into large sums over years. Don't shy away from tough conversations. They often determine the difference between poverty and wealth. 26. Embrace failure and learn from mistakes. Everyone fails at some point, especially on big endeavors. Instead of seeing failure as a setback, treat it as a lesson. If an investment or project doesn't pan out, analyze what went wrong and apply that insight moving forward. Resilience is a key trait of successful people. For instance, many entrepreneurs recount early businesses that failed before they hit on the right idea. What kept them going was learning from each misstep. Perhaps they needed better marketing or stronger cash flow control, and adapting their strategy. By bouncing back and refining your approach, failure becomes a stepping stone rather than a roadblock. Cultivate the mindset. The only true failure is in refusing to try again. Each mistake teaches you more than years of complacency ever could. 27. Cultivate a growth mindset. Always keep learning. Markets change, technology evolves, and new competitors emerge. To stay ahead, commit to lifelong learning. A growth mindset means believing you can develop skills over time. Read books on finance, Take courses to sharpen your expertise and learn from mentors who have walked the path. Constantly updating your knowledge helps you spot new opportunities and avoid outdated practices. For example, a small business owner might learn the latest digital marketing tactics to reach more customers. Even after finding success, continue learning. Successful people often allocate time daily to study. By improving yourself a little each day, you compound your ability to make and keep money. 28. Set clear goals and track your progress. A goal gives you direction. Instead of vague wishes, I want to be rich, define specific targets. I will save $10,000 by next year, or I will grow sales by 20% this quarter. Write these goals down and review them regularly. Track metrics that matter, like net worth, debt levels, or monthly revenue. When you measure progress, you can adjust course as needed. For instance, if you find you're saving only half the amount toward your goal, you might cut an expense or increase income efforts. Goals also keep you motivated by giving you something to achieve. Make your goals ambitious but realistic, and celebrate small wins along the way to stay encouraged. Clarity and accountability in goal setting turn dreams into concrete financial results. 29. Prioritize your health and energy. No amount of money is worth it if you're too exhausted or ill to enjoy life. Maintaining physical health and energy is a fundamental investment. Good habits like regular exercise, adequate sleep, and a balanced diet boost your productivity and brain power. When you feel strong and alert, you make better decisions and work more effectively on income-generating activities. Neglecting health often leads to medical bills, lost work, or burnout, all of which can drain your finances. Schedule your exercise or wellness time just like a business meeting. Think of good health as compounding equity. The more consistently you invest in it, the greater your payoff in terms of longevity, focus, and stamina for the long journey of wealth building. 30. Surround yourself with successful, positive people. Your social circle influences your habits and mindset. Spend time with people who inspire you, challenge you, and have financial goals of their own. Discussing ideas with motivated friends or mentors can spark new opportunities and keep you accountable. Conversely, avoid constant exposure to negative individuals who discourage ambition. Networking with people who have already achieved what you want can also open doors. They might share advice, partnerships, or referrals. In practice, this could mean joining entrepreneur groups, attending seminars, or simply having regular coffee with proactive peers. By raising the bar of your surroundings, you raise your own performance and accelerate your path to success. 31. Practice patience. Wealth often takes time. Wealth is usually built slowly. Overnight success is rare. Even when it looks that way, there was often years of unseen effort behind it. Stay patient as you work toward your financial goals. Focus on consistent daily actions rather than quick fixes. For instance, keep investing every month and trust that in 10 or 20 years it will grow significantly. If a great opportunity takes months or years to materialize, don't get discouraged. Many startup founders and investors mention how their biggest break came after years of hard work and waiting. By being patient, you avoid rash decisions out of frustration and allow the power of compound growth and long-term plans to work their magic. Remember, success is a marathon, not a sprint. 32. Stay humble and open to new opportunities. Arrogance can blind you to better ways of doing things. Even as you progress, maintain humility. Every so-called expert was once a beginner. Be open to feedback and new ideas. For example, if a new technology or market emerges, be willing to learn about it rather than dismissing it as a fad. Staying teachable allows you to pivot when needed and adopt innovations that give you an edge. Humility also makes it easier to form partnerships and collaborations, as people prefer to work with others who are respectful and open-minded. In summary, Recognize that you don't have all the answers. Embrace continuous learning and be ready to seize unexpected opportunities that humility and openness reveal. 33. Remember, wealth is a journey. Enjoy the process. While it's important to have goals, don't forget to appreciate your progress along the way. Stressing only about future riches can make you miss the satisfaction of small wins and the lessons learned. Celebrate each milestone, whether it's your first big sale, eliminating a debt, or hitting a savings goal. Cultivate a positive attitude toward the hustle itself. Many successful people say they loved the work and challenge even when the bank balance was low. Enjoying the grind keeps you motivated and prevents burnout. It also means balancing life and money. Spend time with family, pursue hobbies, and take breaks when needed. When you find joy in the process of improving and creating value, success tends to come more naturally and sustainably. 34. Take consistent action even if small. Big plans are useless without steady action. Commit to doing something toward your financial goals every single day or week. It could be making a sales call, learning a new skill, or reviewing your budget. Even small steps, taken regularly, accumulate into significant change. For example, reading 10 pages of a finance book daily or improving 1 percentage point of profit per week can transform your life over a year. The key is momentum. One step leads to another. On days you feel unmotivated, remind yourself that imperfect action is better than none. Consistency builds habits and confidence. Before you know it, these daily actions become automatic, and you'll look back surprised at how far they've brought you. 35. Focus on high-impact activities. Time and energy are limited, so spend them on tasks that move the needle most. Identify which activities yield the largest results for your income. For a salesperson, that might be client meetings rather than paperwork. For a writer, it might be producing content instead of tweaking fonts. To determine what's high impact, ask yourself, what one activity will get me the most money or growth right now? Then prioritize that. Limit time on low-value tasks, or automate them as much as possible. By focusing on high-impact work, you increase your efficiency and accelerate progress. Your goal is to produce massive results, not just busyness. Ask often, is what I'm doing now the best use of my time? 36. Adapt quickly to market changes. Markets, technologies, and consumer preferences change over time. What was lucrative last decade might be obsolete today. To keep making money, be ready to pivot when needed. Stay informed about trends in your industry and broader economy. For instance, if a new software is revolutionizing business operations, learn it before your competitors do. When you see a shift, like a new customer need or a regulatory change, adjust your plans. Adaptation could mean offering new services, learning new skills, or shifting target markets. Businesses that could not adapt have folded, while those who change survive and grow. View change not as a threat, but as an opportunity to innovate. By evolving with the market, you keep your competitive edge and continue creating value under new conditions. 37. Plan for the long term, not instant gratification. Quick wins and shortcuts often lead to dead ends. Instead of spending time on get-rich-quick schemes, invest in strategies that may take longer, but build lasting wealth. This means setting up retirement plans, long-term investments, or education that pays dividends years down the road. When faced with spending versus saving, choose what benefits your future. For example, rather than splurging on a luxury now, you might invest that money in a skill course or a low-cost index fund. Long-term thinking also means delaying immediate pleasures for bigger rewards later. The satisfaction of watching compound interest grow or a business scale over years far outweighs the fleeting thrill of impulsive purchases. By focusing on the horizon, you make choices that truly enrich your future life. 38th. Track performance and continuously improve. What gets measured gets managed. Keep a close eye on your financial dashboard. Track income, expenses, returns, and other key numbers. Regularly reviewing this data shows you where you stand and highlights areas for improvement. For instance, if one side business isn't making money, you might cut it or refine it. If your investments underperform, you can rebalance your portfolio. Use benchmarks to measure progress. Compare month to month or year to year. Learning from the data, refine your strategy. Cut out wasteful costs, allocate more to high-return areas, or acquire skills where you're weak. This process of measurement and adjustment is at the heart of continuous improvement. By making it a habit, your financial practices become smarter and more effective over time. 39. Read and learn from mentors and experts. You don't have to figure everything out alone. Read books by successful business people and investors, listen to interviews, or find mentors who have done what you're aiming for. Their experiences can give you shortcuts to avoid common mistakes. For example, someone who built a company can teach you pitfalls to avoid on hiring or marketing. You can join forums or networking groups and ask questions. Treat the learning process as an investment. Each new insight is a tool you can use. Even modest reading or talking to one informed person a week accelerates your growth compared to zero input. A well-chosen mentor or role model can steer you toward success faster than you could on your own. So seek out those who challenge and inspire you. 40. Live below your means and budget wisely. Wealth is not just about how much you earn, but how little you spend relative to that. Practice financial discipline by creating and sticking to a budget. Track your spending categories, housing, food, entertainment, etc., and identify areas to cut back. For example, you might cook at home more and eat out less, or refinance high-interest loans. Each saving adds directly to your investment pool. The habit of frugality doesn't mean never enjoying life. It means spending consciously on things that matter and trimming excess. As your income grows, resist lifestyle creep, the urge to spend more just because you earn more. By consistently spending less than you earn, you free up resources to invest, speeding up your journey to financial goals. 41. Build multiple revenue streams. Relying on a single source of income is risky. Instead, diversify how money comes in. This might mean having a side business, freelance work, rental income, or investments that pay dividends. For example, a graphic designer could work part-time in an agency while selling print designs online. Multiple streams ensure that if one weakens, say, you lose your main job or a market slows, others are still flowing. Over time, these can also overlap and support each other. The second benefit is that building new streams often leverages skills you already have, compounding your earnings. By thinking creatively about how to earn from different angles, you create financial resilience and accelerate wealth accumulation. 42. Leverage other people's resources wisely. One key to big growth is using resources beyond your own. Other people's money, OPM, time, and networks. For instance, taking on investors or loans can allow you to expand your business faster than only with your savings. Hiring talented team members or partnering with others lets you accomplish more than you could solo. However, always use leverage judiciously. Only take on debt you can handle, and make sure partners or employees are aligned with your goals. When done correctly, leverage multiplies what you can achieve. For example, a loan used to buy efficient equipment can pay off by generating more revenue than its interest cost. The general rule is to expand capacity through OPM, or help when it amplifies your efforts, but manage that leverage carefully so you maintain control. 43. Cultivate gratitude and contentment. Money isn't everything, and constantly yearning for more can make you unhappy. Cultivating gratitude for what you have, good health, relationships, education, or progress you've made, actually strengthens your mindset. When you feel positive about what's already going right, you reduce stress and make clearer decisions. Contentment doesn't mean complacency, but it means celebrating small gains and having faith in your path. For example, acknowledging a pay raise or a business milestone can inspire you to aim higher rather than feeling always lacking. Gratitude helps prevent burnout and keeps your priorities in perspective. By appreciating the present, you stay motivated for the future and avoid making reckless choices driven by fear or envy. 44. Compete only with your past self. Your biggest competition should be who you were yesterday, not who someone else is today. Focus on beating your own records, saving more than you did last month, improving a skill, or increasing sales. Tracking your own growth is more productive than comparing to friends, neighbors, or online influencers who may be in different situations. When you aim to outdo yourself, you build confidence and momentum. Each personal victory, even small, reinforces the habit of improvement. Over time, these self-competitions add up to exponential growth. So when you feel tempted to compare, simply ask, am I closer to my own goals than I was yesterday? If yes, you're winning. This mindset keeps you grounded and motivated without the distraction of others' success. 45. Give back generously. Help others. Ironically, one way to enrich your own life is to help others. Generosity, whether through money, time, or knowledge, builds goodwill and often creates opportunities you wouldn't have otherwise. Helping others can strengthen your network. You meet people, earn their trust, and they may reciprocate or connect you to new prospects. Giving also shifts your focus from scarcity to abundance, which is good for mindset. For example, teaching a skill to someone for free might lead to a future partnership or referral. Additionally, philanthropy or volunteering gives perspective and fulfillment that pure material gain cannot. By sharing your wealth and skills, you reinforce a positive cycle. Wealth fosters generosity, and generosity often attracts more wealth in various ways. 46. Protect your wealth, insurance, diversification. Once you start accumulating money, take steps to safeguard it. Just as you would buy insurance for your car or home, insure your financial life against major losses. This could include health insurance, business insurance, and even life insurance if others depend on you. Protecting your wealth also means continuing to diversify as you grow. Don't suddenly put all your gains back into one business or stock. Maintain an emergency fund, as earlier mentioned, and continue spreading investments. Legal protections like wills or asset structures can also prevent wealth from being lost through lawsuits or creditors. In essence, treat your accumulated assets with care. By protecting your wealth, you ensure that future shocks, illness, lawsuits, market crashes, don't erase all the progress you made. 47. Teach others, build connections. Sharing your knowledge or mentoring others can actually enhance your own success. When you teach or help someone with money matters or business, you reinforce your own understanding and reputation. It also expands your network. Students or colleagues may later return the favor by introducing you to opportunities. For example, giving a workshop on a skill can position you as an expert, leading clients or partners to approach you. Building connections through teaching fosters mutual support and can even lead to joint ventures. Remember, wealth building is not only a solo race. The people you meet through generosity can become collaborators or advocates. By contributing to others' growth, you often unlock unexpected doors for your own wealth journey. 48. Think and act like an owner, not an employee. To build wealth, adopt the mindset of a business owner or investor. Employees trade hours for a fixed wage, which has a natural limit. Owners and investors, however, own processes, products, or systems that earn money even when they're not working. This doesn't mean quitting your job immediately. It means starting to behave like an owner, set systems, delegate, and look for passive income. For example, write a blog post once that continues to attract clients over months, or create an online product that sells continually. When decision-making, ask, if this were my business or my money, what would I do? Shifting from an employee mentality, fear of risk and change, to an owner mentality, valuing leverage and growth, multiplies your earning potential and sets you on a path to lasting wealth. 49. Follow through with consistency. Big goals mean nothing without the discipline to follow through. Whenever you make a plan, a savings target, a new habit, a business goal, ensure you execute it consistently. This means showing up every day with effort, even if the gains seem small. If you resolve to save 10% of income, make sure you automate that or double-check each paycheck. If you plan to learn every week, schedule it and stick to it. Many people start strong but fizzle out. Don't be one of them. Use tools like calendars, reminders, and accountability partners to keep yourself on track. As you consistently follow through, complex tasks become routine, and substantial progress becomes inevitable. In the end, consistency, even more than intense one-off effort, creates momentum and achieves real results. 50. Innovate to stay ahead. Complacency is wealth's enemy. As soon as something works, always ask, can this be done better or differently? Innovation means continuously improving your products, services, or processes. Pay attention to feedback and new ideas. For example, a shop owner might add online sales options, or a freelancer might learn cutting-edge software to offer new services. By innovating, you attract customers, stay relevant, and sometimes create entirely new markets. Don't be satisfied with good enough. Challenge the status quo in your work. Improve efficiency, upgrade quality, or find a niche no one else has tapped. Innovation often starts as small tweaks, but over time it can dramatically increase your competitive advantage and profitability. Staying ahead of trends keeps your income streams fresh and growing. Each of these principles is a building block. Applied consistently and thoughtfully, they form a powerful roadmap to financial success. Together, they guide how you think about money, the habits you develop, and the actions you take to grow and protect wealth. Remember, building wealth is a long-term journey. Keep learning, stay disciplined, and adapt as you go. Good luck.